The wealthiest families in America buy life insurance they never plan to collect on. For them, the policy was never about death. It is how a fortune reaches the next generation with no estate tax, growing for years out of reach of the Internal Revenue Service. But that is the strange part. The government built that tax to break fortunes exactly like these. Instead, it left open the one door that walks straight past it. Today, $40 billion sits behind that door, and after more than 50 years, no one has managed to close it. Ask most people what life insurance is for, and you tend to get the same answer. It's the thing that pays off the house if a parent dies too young. A backstop, something responsible people set up once and then never think about again. And for most families, that really is the whole story. The check clears, the mortgage gets covered, and the family keeps its footing. But walk into the right office, on the right floor of the right building, and the same product is doing something else entirely. Same contract, same fine print, a job no commercial has ever mentioned. To see how one ordinary product ended up living two completely separate lives, you have to start with the tax that set the whole thing in motion. In 1916, with the country drifting toward the First World War, Congress passed the Revenue Act and created the modern federal estate tax. It opened at 1% and climbed to 10 on the largest estates. Nobody was coy about the target. The reformers who pushed it through wanted a way to chip apart the great fortunes of the Gilded Age, the Mellons, the Rockefellers, the handful of families who had spent half a century turning the American economy into a collection of private kingdoms. The tax was aimed straight at dynasties. So the dynasties went looking for the exits, and Congress knew they would. The first exit was obvious enough. If the tax hits whatever you still own the day you die, then give it all away the day before. So in 1924, lawmakers bolted on a gift tax to slam that one shut. But one thing kept slipping clean through both nets: life insurance. The payout was built to arrive free of income tax, and if you set the ownership up the right way, it stayed outside your taxable estate completely. By 1954, Washington had finally caught the pattern and moved to fix it. The tax code was rewritten that year to haul most life insurance proceeds back into the estate where they could be taxed like everything else. As far as the government was concerned, the door was shut, locked, and the key thrown away. That was the trap, sprung and bolted. The man who picked it back open had never spent a single day working in finance. In 1962, a doctor out in California named Clifford Crummy set up an irrevocable trust for his 4 kids. They were 11, 15, 20, and 22. What he was after could not have been more ordinary. He wanted to move money down to his children while he was still alive, get it out of his own estate, and hold on to some say over how it was used until they were old enough not to do something foolish with it. But the tax code blocked that exact wish too. Money parked in a trust counted as a future interest, something the kids couldn't actually touch yet, and future interests did not qualify for the annual gift tax exclusion. So every dollar Crummy moved in was going to chew through his lifetime exemption or get taxed on the way through the door. The simple version of his plan was dead on arrival. Then, his tax advisor caught something nobody else had thought to try. Write the trust so each child gets a short window, just a couple of weeks, to pull out that year's deposit and keep the cash. That little window turned the gift into a present interest. And here is the part that makes the whole machine run. The children were never actually meant to take the money. The youngest was 11 years old. Even the oldest could see that grabbing his share would shut off every gift that came after it. The right to withdraw just had to exist on paper. Existing was the entire job. And honestly, the design borders on comedy. The whole structure leaned on handing children a choice that everyone involved was betting they would politely decline. The more reliably the kids said no, the better the thing worked. A plan that succeeded precisely because nobody ever used the rights it was built on. The Internal Revenue Service smelled a scam right away. It audited the gifts, tossed out the exclusions for the younger children, and argued that a kid with no appointed guardian could not seriously walk into a bank and demand thousands of dollars. The right was theoretical, the government said, a bit of legal fiction dressed up as a gift. And the sums in the fight were comically small. Each parent had claimed a few $1,000s in exclusions for each child across the 1962 and 1963 tax years. The government wanted to allow only a sliver of that and tax the rest. The money actually in dispute would barely have covered a new car. This was not a billionaire squaring off against the state. It was a doctor and his accountant arguing over pocket change on a fine point of law that would one day move billions. But in 1968, the Ninth Circuit Court of Appeals sided with the doctor. The judges ruled that the only thing that mattered was the legal right to ask for the money, not whether anyone on earth expected a child to actually do it. The gifts counted. The decision was dry, narrow, and the newspapers barely noticed. The estate planners, they noticed. They read it within the week, and they understood exactly what that quiet California lawyer had just built for them. That was the legal foundation. What got stacked on top of it is where the $40 billion begins. The thing they stacked on it carries a clunky name: the Irrevocable Life Insurance Trust. What it actually does is a good deal simpler than the name suggests. A wealthy person sets up the trust. The trust owns a life insurance policy, not the person. Every year, the person hands the trust just enough cash to cover that year's premium. Because of the crummy ruling, the beneficiaries get their little withdrawal window each time the money comes in. So every payment slips under the annual exclusion. In 2026, that exclusion runs $19,000 per person per year, entirely tax-free. The beneficiaries pass on the withdrawal the way they always do. The premium clears. Same quiet dance, year after year, sometimes for 30 or 40 years running. Then the person dies, and the policy pays out. On paper, that money was never theirs to begin with, so it never lands inside the taxable estate. The heirs collect the whole thing with no estate tax and no income tax on the benefit either. The reason was never some typo buried deep in the code. It was the shape of the arrangement itself. Move ownership one step away from yourself, and the tax goes chasing ownership, not the family quietly getting rich off the payout. This is the line where old money stops thinking like everybody else. A regular family buys life insurance to replace a missing paycheck. A dynasty buys it to carry a balance sheet across a generation. The product sitting on the desk is identical. What the two of them want out of it is the opposite. And that difference shows up in the hard numbers in a way that's tough to argue with. Stretch that across a few decades and the logic sharpens. A family that funds one of these trusts in their 50s can let it sit and compound untouched well into their 80s. By the time the policy pays out, the premiums they put in year after year look trivial next to what the heirs pull out the other end. Time does the heavy lifting here. The wrapper just makes sure the government never takes a cut on the way through. The estate tax is very much still on the books. It still takes 40% of everything above the exemption line, but it has almost nothing to do anymore with the people it was written to catch. Back in 1976, around 139,000 estates paid it. By 2019, after tools like this one had quietly spread through wealthy America for half a century, barely 6,500 even filed a return, and fewer than 2,600 actually paid. In a country of 330 million people. The fortunes did not get smaller. The exposure did. A tax built to break great fortunes now mostly lands on the families who are too small or too slow to build their way out of its reach. So the structure works. The catch is it never stopped evolving. What the truly rich reach for today makes old Dr. Crummey's little trust look like a toy. It goes by Private Placement Life Insurance, PPLI if you want the shorthand. It takes that same tax-free wrapper and packs it with things an ordinary policy would never come near. In a normal policy, the cash value sits in plain, boring funds. In a PPLI policy, It can hold hedge funds and private equity, the high-octane investments that would normally get taxed hard every single year. Tuck them inside the insurance wrapper, and those gains pile up with no annual income tax at all. Need money to actually live on? You borrow against the policy instead of selling, and a loan is an income, so there's nothing to tax. Then the owner dies, and the entire stack rolls down to the heirs with all those built-up gains wiped clean off the bill. The industry even has a tidy little name for the sequence: buy, borrow, die. And the barrier to entry alone tells you who all of this was built for. Industry figures put the practical minimum at around $2 million just to open one of these policies, and closer to $5 million before the strategy is even worth the trouble. A product that starts where most people's entire net worth ends. That is not an accident of pricing. It is the whole design. In 2022, the Senate Finance Committee went looking for the real size of this market. The numbers it came back with are the part worth sitting with. 7 insurers alone turned over records on more than 3,000 active policies. The face value came to about $40 billion. The average death benefit ran close to $13 million a policy. At one of those 7 companies, the average policy paid out $38 million. The average. All of it added up to 0.003% of every life insurance policy in the country. This was never a product built for families. It was built for a few thousand of the richest people on the continent, and almost no one else has ever heard of it. The committee dug for 18 months. Its big headline finding was that almost none of it actually broke the law. The report finally landed in February 2024. It found that the Internal Revenue Service basically can't enforce the rules already sitting on the books, and for a laughably simple reason. Nobody is required to report these policies in the first place. You can't police what you're not allowed to see. Senator Ron Wyden filed a bill to shut the whole thing down. A second version turned up in 2026. But the door that California lawyer cracked open back in 1968 is still standing wide open today. Pull back far enough, and the picture gets almost too neat to believe. In 1916, a government built a tax for the express purpose of dissolving dynastic wealth. Decades later, an ordinary doctor trying to look after his 4 children handed the largest fortunes in the country the exact legal key they needed to walk straight past it. He was not a rich man, not by the standard of the families who would end up carrying his name on their paperwork. He never owned a private placement policy. He was solving one small problem for one household. And he solved it, and as far as the record shows, he never gave it another thought. The families who came after him read that small fix as a blueprint, and they have kept it humming ever since. Today, the estate tax brings in about 0.5% of all federal revenue, and the people it was written to rein in are, by and large, the very people who no longer pay it. The $40 billion isn't even the real total. It's only the slice the Senate managed to actually see. The rest sits in trusts that report nothing to anyone, owned on paper by no one in particular, sliding down to the next generation exactly the way it was drawn up to. A law built to work against the richest families in America quietly ended up working for them, and the men who could have closed it have spent more than 50 years learning that you can't lock a door when the law says you're not even allowed to look at it. For the families who understood all this early, the most boring product in finance turned into the steadiest bridge they would ever own. The cipher has always existed. Now you know where to look.